Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everyone. Thank you so much for being here on this edition of the REI Hacker Podcast. My next guest is Aaron Fragnito. He's the co-founder of People's Capital Group. Aaron is a full-time real estate investor with a primary focus on helping accredited investors, family offices, and IRAs preserve their wealth in real estate. He also runs the New Jersey Real Estate Network and hosts the Passive Cash Flow Podcast. Aaron has completed over 300 real estate transactions and has helped over 100 people build wealth in real estate. He's also built an 8-figure real estate portfolio and is well known throughout the New Jersey real estate investment industry. Aaron, thank you so much for being here. I really appreciate it.
Thanks for having me on, Benson. Always a pleasure here to jump on the podcast.
You got it. Man, I have so many questions for you. You were an adjunct professor for Rowan University. You're not still doing that, are you?
I just did that for one semester. I graduated from there in 2009, and they needed someone to write and teach a course called Real Estate and Entrepreneurship. And I was like, no, I'm not going to do that. I don't have enough time to write and teach a college course. Sounds like a lot of work. And then they came back to me like in August, and they're like, well, we can't find anyone that is actually in the industry doing what you do to write and teach this course. We really want someone that's a Rowan grad that is actually out there syndicating deals and buying commercial real estate. And I was like, all right, how hard could it be to write and teach a college course? So I signed up for one semester and I did it. It was much more work than I thought, but it was very good, the experience, in that I really learned my craft. You know, when you teach something, you learn it even better. So it was a great experience. Yeah. It was nice to give back from the university I graduated from.
That's pretty cool. So you got to see both sides of, learning real estate, entrepreneurship. Basically, academia versus, on-the-job training. What do you think the biggest thing is that universities get wrong about the realities of real estate entrepreneurship?
It's difficult because I always said to myself, I'm going to be one of those professors that really engages the classroom and gets them out of their seat. And like the thing I hated about school was they just preached at me, and we sat in one side of the room. They just told us, what to do, and there was no engagement. I wasn't engaged enough. Then I found myself doing exactly that because it was so hard. I have so much information. I think the mistake I made was I compressed way too much information into a, Thursday night course over, 3.5 months. It really goes much faster than you think, especially, with Thanksgiving and then Christmas, so you really have less time than you realize. So, the bottom line is I spoke to one of the professors there, and he had been there a long, long time. Kind of your classic professor who was never really in the industry, but was very experienced in teaching, and I'm sure very knowledgeable on the subject. And he suggested put a bucket in the front of the room and have the students throw a tennis ball into the bucket from different distances to the bucket. And that lesson teaches that, you don't all start in the same place with entrepreneurship, but the goal is to do the same thing and get the ball in the bucket. And I was like, yeah, I guess so. Like, to me, that just seemed like a waste of time. I was like, man, if you really knew how hard it was to start a business from scratch, and raise money and lose money and grind it out day in and day out, man, like, you got to want it. You got to want it a lot more than throwing a tennis ball in a bucket. And, but I get it. Here I was being a new professor, not knowing how to get kids out of their seats. And that's the solution, to get kids out of their seats. But I just feel like the disconnect is, that's one thing I taught to the children, the young adults, was that this is not for everyone. Entrepreneurship is glamorized by Instagram and media and whatever, YouTube and whatnot. So it is not what you think it is. It is hard. It is not Ferraris and, houses in Palm Beach and, beautiful women on your arm and diamonds. Man, it is like the opposite of that. It's ramen noodles. It's driving a car with a dent in it. It's losing the girl because she said you're not successful fast enough. I mean, I can't even count on one hand how many women I dated and they realized, well, you have all this real estate, you have all this business, but you're not taking me on fancy vacations. You don't drive a $100,000 sports car. You don't have vacation homes. Like I expected a certain lifestyle dating a successful entrepreneur. Why are you putting all your money back in your business, not spending it on me? And they're out the door. Now that's a whole different podcast about finding a quality partner.
It is. We should you should do that.
That's a whole different freaking podcast. But the bottom line is, it's tough, man. You got to grind. You got to reinvest in that business. You got to want it. Be up early, up late, and it's not for everyone. In fact, most people should just work a nice job, get a good degree, go to work, make good money, invest as a limited partner in these opportunities. And I mean, I've had like doctors come to me and be like, hey, I make $400,000 a year. I have these medical degrees. I have a successful practice or whatever. I work at a hospital, but I want to do what you do. I want to be a general partner. I want to be out there finding deals and closing real estate deals. I'm like, no, you don't. You're making $400,000 a year, buddy. You're being a doctor. People trust you. You're helping people live healthy lives and saving them from sicknesses. You're really providing value to our community, and you're doing very well, and you're financially rewarded for it. Like, do not stop what you're doing and become a real estate investor. It's not as glamorous as the books and CDs make it seem. It is hard work, and there's a good decade of grind before you get that payoff. And it might not even come. You might fail. You might lose money, man. I mean, it's so anyway, that's
well, investing is even much different than normal entrepreneurship because it's typically passive.
Right.
And it takes longer to build up liquidity in a portfolio over time that actually pays you to where you can leave your 9 to 5. And that's much different than what people think about entrepreneurship is you're a part of a business that's out there generating cash actively and it pays you every day. I mean, is that part of what you taught the young people in this course? Is that like, okay, there's entrepreneurship, but investing in real estate is a much different thing.
Yeah. I mean, I was trying to kind of marry the two of real estate. The course was called Real Estate Entrepreneurship. So the idea was you went out and you started like a house flipping company or a real estate syndication company and things like that. And I explained, listen, there's other ways to make money in real estate too. You could be a realtor. That's kind of entrepreneurial. You're building your own brand, or even a mortgage broker or something. You're building your own brand. But the focus was primarily, house flipping or buying rentals, and then raising capital was a number of sessions we did as well. But I just, and I wanted to make it clear though, like, to the children, because I felt like I majored in entrepreneurship at Rowan University. And by the way, Rowan's a great school, great professors. I had a good experience there, both teaching and learning. And, but I felt like they left it a little open-ended. And unfortunately, not all the professors, but a number of the professors I had weren't really in actually starting and running businesses. Because the truth is, if you're really starting and running businesses, you don't really have time to go and teach a college course. Maybe you like retire and like that's what you do now to kind of give back. But like there were a couple guys that were there that like ran businesses and they also taught courses. And I remember them telling us like they slept like 4 or 5 hours a night. And I was like, that doesn't sound good. I sleep like 12 hours and I'm a college kid. And so that was at the time. And that was, what I realized though, like those guys are like, hey, this is a tough choice. Like you can just get a degree in, business and be in business management, be like a C-suite executive and work your way up the corporate ladder. And like, yeah, you're going to work hard. You're going to build someone else's dream, but you can also build your dream alongside that and invest wisely and have a very nice life and retire at a reasonable age and work hard, and build your way up in like business, but if you want the path less traveled, that does not guarantee success. That means you're going to work harder and longer hours than the 9 to 5ers, but you ultimately could really create your own vision, your own destiny, and ultimately far exceed the income levels of the, C-suite executives. Then there is this option for entrepreneurship. And it was never really explained that way to me. It was always like, oh, you could be a business executive or you could be an entrepreneur. They're both, going to require a lot. I'm like, no, like one's a lot harder than the other, And,
it really is. And the mindset's way different too, right? Because the entrepreneurial side of the fence like you're basically the one that's holding yourself accountable. And so if you don't have the ability to look at yourself in the mirror every day and be like, okay, I'm not doing good enough, then it's going to be very hard to succeed unless you stumble into success, which is a small percentage of the entrepreneurs that have any success. I mean, then all the odds are against an entrepreneurship from the beginning. Like, what is it? Like 95% fail within the first 2 or 3 years. And then the numbers just dwindle over time. So anybody who's having any success really has what it takes. And I talk with people every day who are chasing that dream, and some guru lured them in with this, $10,000 course that promises that they're going to, live their financial dreams, and they're going to be working off a beach someplace, and the Ferraris and everything else that you mentioned, that all the parts that are glamorized, but it's just not the case. And it's unfortunate, but that's why I like what you're doing with syndications, is that a lot of people realize that the best way to accumulate wealth in our country and most other countries is through real estate. And even if they try their hand through some guru's course or by doing flipping or acquiring rentals and they just don't quite get there, there's still a way for them to do that by investing into a syndication, a multifamily property, or some other vehicle that you're able to find. So it's still available there if they know where to look.
Yeah, exactly. And a lot of the deals we do are like, all the deals we do, our LPs make more money than we make, and that's because they're bringing in the majority of the capital. But you got to recognize money is the best way to make money. Building a business from the ground up with limited resources is extremely difficult. So yeah, absolutely. If you can make good income elsewhere and then reinvest that wisely in passive investment opportunities that also, work while you're sleeping. Like the challenge of running a business, creating a business, like mine is, truthfully, if I were to like decide to step out, tomorrow, like the business, I don't really think we keep going, because it's really around people invest in people, they invest in you. We obviously we have the staff, we have the people behind us, but if I'm not running the show on the capital raising side, if my business partner is not running the show on the operations side, we do work a lot in our business still. Now, over the next decade, our plan is to build our business up to the level we're not working in our business and we're just working on our business, and we can live a lifestyle that is that desirable lifestyle of the Ferraris and the vacations and the checking your phone when you're on the beach and seeing, $100,000 come in. Like those days are possible, but that's probably going to be like after 20 years of working at, putting a business together that's successful. There's no guarantee we'll get to that level either. So that's also the challenge of working, in your business and on your business. And I think for many years and I still make the mistake of working in my business more than I should, but I also need to at this point. Because I can't outsource everything, and I need to be running certain aspects of it. So yeah, but that's a kind of a different point there.
Yeah. One of the interesting things about syndications that's different than other real estate investing strategies, even in the entrepreneurship world, is the timeline from where you start the investment to when there's a payout, anywhere from 3 to 5 years. So there's this gap between all the work that goes in up front to capitalize the project, get it funded, and when real money is made. Maybe as a syndicator, you work in some fees, so that you can get some pay over time, but that's a competitive space, right? Like low fees maybe brings more investors in, and right. You probably couldn't live off of just one fund. You'd have to have something else going on. So what are some strategies that you use, or maybe some strategy you can share with the audience about, like, okay, if you're going to go into this world of syndication, how do you make it those first few years where you really don't have a track record or any sort of, income coming in?
Yeah, well, those, right, two different things. So the track record, is tough. You might want to bring on a partner that does have some track record in the business, or partners that have experience, right, investing and operating and managing real estate. And because otherwise, the way I got started was as a realtor. I learned the industry as a realtor. I made connections. I learned the business. I built the relationships with other investors who were actively investing. I said, hey, why don't you invest? I just bought your last 3 deals. I'm a good deal source. I'm a good businessman. I work with integrity. Why don't we do a deal together? And I'd say, yeah, sure. I like buying deals from you. You're a sharpshooter and you're a good resource to me in business. And I like doing business with you. So it seems like you are going to go places, and I'll put 50 grand into your next deal. I started with flipping houses. And then I started a REIA called New Jersey Real Estate Network, which we now have about 5,000 members in, and started getting people to come out to those. I would go to different real estate networking groups. I would speak there, then I would advertise mine, and more people would come in, and then we do whatever, put stuff on social media, and just have different speakers as well that had a bit of a draw, and then just kind of build our groups day by day. We did those every single month for many years. And I would ultimately be the keynote speaker and, build rapport, and they'd know, like, and trust me that way, because someone has to know, like, and trust you to write a check to invest in you. And they'd see me speak every week at the REIA, and a month at the REIA. I'd have different sponsors there that would cover the cost of it. So it would ideally be like a free way to market out our company and our brand. And we say, oh, by the way, we have this investment opportunity. If you want to learn more about it, let's talk after the session here. So that's how we started raising capital. Friends and family also was the first source of capital. We exhausted that pretty quickly after we bought 125 unit. Then we tried to buy another one and realized raising money from non-friends and family was really tough. And we actually had to back out of the deal. That was like 10 years ago because we didn't raise enough money in the time we need to close out the escrow. So we learned the hard way, that you needed to have a fundraising system in place and relationships in place to really raise capital on a large scale. But that is the absolute hardest thing I do, is raise capital. Finding a deal, managing real estate, that's all very technical skill and operational skill. You need to know that stuff as well. But man, raising capital is a whole different beast. It's like the pinnacle of sales and marketing and branding and relationships, and your track record has to be there. But you got to partner up with someone whose strengths complement your weaknesses. In my case, I was good at finding deals. I was good at sales, marketing, and public speaking, but I was broke and I didn't have a very good operational experience. My business partner had sold a medical billing company, so he was liquid. He was operating his properties. He had the same vision as me, Seth Martinez, and we said, okay, you are good at the operations side, Seth. You have some liquidity. I was starting to make a little money with commissions and things like that, but I was better at marketing, sales, and branding, and public speaking and capital raising. So we said, well, our strengths really complement our weaknesses, and we have the same vision for 5, 10, 15 years down the road. So we embarked on People's Capital Group in 2013. So if you don't have a track record, bring on a partner that does, but bring some value to the table yourself as well.
Oh yeah. Yeah. That's a tough part about it. I started a fund, last year, and it has been a challenge. I am licensed and I'm in the space of real estate investing. I've been doing it in one way or another for the past 20 years. But this is my first hand in sort of like large capital raising efforts. And it's definitely a challenge. Even just asking people for money is a little weird, right? Because you can go in and vet out a deal, back to front, and really just make sure it has everything you're looking for. But even so, you don't know. And so that risk that you're passing on to your investors, it can keep you up at night. Have you had any issues with, okay, I found the deal, I believe in it, I want to put it in front of people, but there's still a chance they could lose their money?
Yeah, and we've never had an investor lose money, and we've never done a capital call, but there is absolute risk to investing. And you definitely second guess yourself from time to time, but you just always need to be improving your underwriting capabilities, improving your operational side, and it is scary to be taking on other people's money. I mean, it's not like everyone that invests with us are like multimillionaires. We do have a number of high net worth individuals, ultra high net worth, and family offices, and we value everyone's money the same. But a lot of our investors, especially getting started, were like school teachers with, $80,000 in their IRA. And they're putting 50 into our deal. That's pretty big trust. And or, you know, a business owner or something that's writing you a check for $50,000. And, you know, we actually had to kind of through the years be like, you know, we need to level up our level of investor, because we would get a $30,000 investment and we would get a call 2 months later and be like, oh, my car broke, I need $6,000 back. We'd be like, oh gosh, like, sorry, buddy, this is a non-liquid investment. So you got to, you know, raise from the right types of investors. So you got to be really careful what you're doing. And the question is to be, we always ask ourselves this, would we put our own money into? Now, we do put our own money into, but it's like, you know, company money that we're putting in. And it's also usually we're rolling in a lot of our acquisition fee as well. And then the other question is, would you put your parents' money into this? You know, your grandma's money, like, you know, and that's the question, you know. And a lot of times when you ask yourself that, like, wait, actually, I don't like this about the deal, and I don't like that about that. I think we're overpaying for it, and this rent control law makes me unsure about it. And, you know, so whatever the situation is, then you start to really fine tune the deal and get very aggressive with your underwriting, more conservative. So that might cause you to lose the deal, right? But I've had investors, you know, I've had deals where we go into the due diligence phase. This just happened to us on a big one. And we found something we don't like, and we end up having to kill the deal. The seller's not willing to renegotiate, retrade. So that does happen. And your investors will come back to you and say, hey, thanks for doing your due diligence and finding that issue and not closing on a deal just to make your fees and get another one checked off on the list. You know, thanks for protecting our investment capital, you know, and backing out of the deal, even though we will lose as a company due diligence costs, you know, the appraisal with the inspections, things like that. Now, you know, we have a due diligence period where we get our deposit back, but you're still spending, like, depending on the size of the asset, like $40,000 on due diligence fees before you might determine you're not going to move forward on it, you know? So, that could be tough. You know, you might say, oh, well, we're just going to go for it because we already spent the money and whatever, we'll figure it out. You know, no, you got to be smart about it. And that's the question. Would you move forward if it was your own money, if it was your emergency savings, you know, if it was your parents' money, or, you know, then, and the answer is no, then don't buy it with your investors' capital.
Yeah. And I mean, this is the stakes are much bigger on this level that you're talking about here, but even on just like a fix and flip, I've been telling people for years that, you know, when you get a lead, you know, don't look for reasons why it's a deal. Like, you should be looking at it the other side, like try to find every reason why it's not a deal. And if you can prove that way, there's not enough evidence to prove that it's not a deal, then yeah, let's look at it. And so it's just a much different way, a more conservative way of underwriting opportunities, because unfortunately, like, deal flow is tough, right? Like, if you don't have a consistent way of providing yourself consistent deal flow, when you do get that lead, they're like, okay, we finally got a lead, let's make it work, right? So because they really want to take it from that lead level to something where they can make some money in. And so people blind themselves with optimism, and they blind themselves with the opportunity of making money and not really seeing the negatives of the property because they don't want to see them. Do you think that's true in this world as well?
Oh yeah. I mean, I've done 300 deals. I still fall in love with my deals, and I know not to fall in love with my deals. Never, ever fall in love with a deal. It doesn't matter how much money you spend on marketing, how much time you spend going through that spreadsheet, doing your due diligence, underwriting. I mean, you're gonna favor that deal. Then what you need to do is bring it to your partner. Another reason to have a good, honest partner, and say, hey, look at this deal I found. And every single time, because my partner runs the debt fund, which is a way we make the quick money. We fix and flip properties. We buy and we get land ready for development. We sell it to builders. We buy small multis. We refinance out of those. So we have a debt fund that kind of creates quick income into the company. To answer your past question about creating quick income in addition to our AUM fees, you know, that'll solve that problem as well. So we do a lot of fix and flips, right? We're still refinancing small duplexes and stuff like that, just to create little revenue streams. And but the bottom line is, you bring that deal to your partner, right? So you've now spent 6 hours underwriting it. You've spent 15 hours doing a marketing you've spent money to find this deal. You relationships. You're in love with this deal. You're blinded by love, and bring it to your partner. He's gonna bring some reality into the situation. Well, what about the rent control? Your repair estimate seems light. I think you're being over optimistic on the resale value. How are we going to, do this? How are we going to turn over that many units per month? And everything, right? So he's going to tear it apart. And that's what a good partner will do, because you are blinded by love. And we all have that bias, right? And love is a crazy thing, man. I'll tell you, we got to do another podcast about love, because, oh boy, it'll blind you, man. I've made some poor decisions there as well. And, no one can tell you otherwise. And then looking back, you're like, what was I thinking being with that person for so many years? They were terrible for me, right? But you were blinded by love, and your heart can want something, but deep down in your mind, it's not the right thing. People say, follow your heart. I'm like, bro, following your heart is one of the stupidest things you can do.
Yeah.
Your heart will lie to you, follow your mind.
Yeah. It's like that whole discussion about the right versus left brain, right? Like people who their whole lives, they go based off of emotion, right? Instead of being rational and looking at things from a perspective of, am I going to win or make money or lose money? And business is one of those places where you really need to be rational about all your stuff and try to keep emotion out of it.
Correct.
Especially when things don't go right. Like that's a place when things are going bad, people really get their emotions involved in decision making, and they can make pretty big mistakes.
Yeah. Well, that's like, man, you watch that show over like American Greed or something. A lot of those people like start off with like good intentions, and then just like didn't have enough money to pay the dividends that month. So they like took a little off the top, and then like they couldn't catch up with that, and they had to take a little bit from over here. Then they had to take on a loan. Then they had to borrow more to pay, like before you know it, they're just like, stealing from Pierre to pay Paul or whatnot. And, becomes like a Ponzi scheme. So like, that's how things go south in business. You got to be just transparent. You got to lead with your mind, and not get too emotional about things, and recognize also, when to hold them, when to fold them, as well. Like I've done deals and I've lost a lot of money, and but we've always wrote a check to our investors at the closing table, and made good to them. And then we just build it back through the years, and try not to repeat those mistakes. You got to learn from your mistakes. And that's the most important thing. Did
you by chance have a piece of your course that you built for the university that was called the Kenny Rogers clause? You got to know when to hold and know when to fold them.
Fold them. No, that would have been good. Maybe I should have incorporated more like one-liners like that,
Yeah.
They say when you write and teach a college course, like the first time you do it is the worst time you'll do it. I feel like I could go back and do so much better with it. I wouldn't have done so much in the course. I would have compressed it into more 30,000 foot view, but I was getting into like IRRs and syndications, and then like the next day, the next week it would be like flipping houses. I was like, and then the next it was like Airbnb, and I was like covering everything in a semester, and it was a lot. And then trying to go into the weeds of some of that stuff too. And I think the guys, the people's eyes would glaze over there, and I'd be like,
oh yeah. And it was once a week?
Yes, Thursday nights. Yeah.
Yeah. That would be hard to cram all that into one and keep it connected too from week to week, like 7 days in between classes. Probably had some self-study stuff they were doing at home in between, but still that would be a challenge. So yeah. Earlier you mentioned that when you guys first started, raising money, that you wanted to level up your quality of investors. And it sounds like you took a lesson from, getting money from friends and family. And so one of the things that you focus on now is going to, family offices and registered investment advisors. And instead of just doing like the one-to-one approach, you're doing sort of the one to the gatekeeper to many approach, which can get you access to way more capital. Was it just kind of like the natural progression of things, or was there something that happened that made you decide, okay, listen, we just need to really level up our strategy?
Well, I bought a 21 unit apartment building in Bayonne about 2.5 years ago. We had 42 investors in that deal. And for years, we had been raising money from our real estate networking group, our REIA. And we were doing 506Bs. So you did not have to be an accredited investor to invest with us. We had pre-existing relationships with every investor through our group there. But that means we were raising money from school teachers at $30,000 a pop, nurses and whatnot. And, it just was very small investments. It was quantity over quality. And we appreciate those investors. They've helped us get here to where we are today. We still have a debt fund that those non-accredited investors can invest in if they want to put their money to work with a minimum investment of $30,000. But, I was 8 years into the business or something at that point, and even more, and like recognizing, what are we doing here? We're working with people. We're in a room where you don't have high net worth individuals, and money is an interesting thing. What is $100 to me or you is $10 to another person, right? Like the amount of wealth in this country is ridiculous. The amount of people who are heirs to family fortunes is ridiculous. We're within an hour of New York City here. I mean, New York City is the capital of wealth and finance and money in the entire world, and there is so much wealth to be accessed by knowing the right people and putting yourself in the right rooms. So family offices have a net worth generally of $250 million or more. They are the buzzword now over the last 3 years, and there's places to meet them. There's groups you can go to. Sure, it's $1,800 to get in the door for a one-day event, but those are the rooms you need to be in to meet those family offices. You can buy lists and things like that, but really the best way to meet them is to pay to play. Get in that room, pay the $2,000, whatever it is. If it's a 3-day event, it's generally like $3,000. And that's not even sponsoring. That's just getting in the room. Sponsoring would be even better. Getting on stage would be even better, but you need like 20 grand for that. So just start by going to these events. Put some money towards it. Pick local ones first. So you don't need to get hotels as much or flights and things like that. There's tons of them out there. You can just Google family office events. I have a whole list if you want to get in touch with me as well. And start talking to family offices. Now, before you do that, know what you're going to say. Know what your business model is. Know what your target returns are. Know about your track record, but also know about sales and marketing. You don't just come into someone who has $250 million net worth and start pitching them deals. It takes like 1 year to 2 years to get a check from a cold open with a family office at an event where they've never met you before to actually getting a check. Generally, they start around $1 million investment. And they grow from there if you perform. So, but it's a process. You want to have your one-page summary ready. You want to have your pitch ready, but it's really about them getting to know you. They're people too. They're going to need to know, like, and trust you. And the first thing is know and like, and you go out to dinner and you talk about family and experiences and so on, and have them ask you for money, right? You said earlier, you don't like asking people for money. Well, the solution to that is to actually get them to ask you about investing, right? Just talk around the point. You don't have to ask them anything. They're naturally going to ask you, well, what are the returns on there? Or how does that work? Or what deals do you have right now? Or, and what's the minimum, what this and that, what's the timeline? And they're just going to ask you questions, right? And if you just kind of naturally talk about your business with passion. But a lot of these meetings, we're not talking about money or business or investments much at all. A lot of the issues family offices have are their heirs. And you generally have a patriarch who worked very hard, knows business, and has that work ethic to build up a family fortune. Then you have the second generation that kind of saw their parents build up that family fortune and recognize what hard work looks like. And they're pretty hardworking themselves. And they're going to build that family wealth to the next generation. Then you have the third generation. The third generation never really had to work for anything in their lives. And work ethic is a really hard thing to teach, really, really hard. And most family offices fail by the third generation. So their biggest concern often is, hey, how is my kid going to learn how to do what you do, how to get up early, work hard, build wealth, preserve and grow people's wealth? I want them to kind of know and be like you. And you say, okay, well, let me take your son under our wing, let me show him the office, have him follow me for a day. I'll show you what I do, and it's a lot of fun. One of them picked me up in his Ferrari, and drove around to different properties all day, and it was really, he's like 20 years old. It was, a fun day, but I mean, just like, it's
That must have
crazy.
been
How do you learn work ethic? You know how many girlfriends he has at 20 years old with a Ferrari? Like, how are you going to focus? You don't focus. How do you focus, right? And I actually realized like that amount of wealth can be a curse. It's not really always a blessing. You think it is. You think, oh man, I wish I grew up with my millions of dollars and never had to work a day in my life. But like, actually, do you? Because when you meet those people, you're like, oh, wait a minute. I have really good habits, and I really am proud of what I created from the ground up. And if it was all handed to me, like, I'd be a completely different person, and with different values. And so we recognize what you have and what you work for.
Yeah. It is interesting. I mean, you have to start them young, right? Just like anything with parenting is you start them young and you teach them discipline. You don't just give them things, when they start crying for something, you don't just give it to them to shut them up. Like that's where it really starts, right? And then they move into adolescence and, being a teenager and they grow up. But yeah, I can see that as a parent, especially somebody who's like a high performing entrepreneur. Like they're busy. They're busy doing all the things to make this business be big and generate a ton of revenue and scale up, and it's an unfortunate story. It probably happens a lot. Like they're not home a lot. They're not the greatest of parents because their baby is their business. Right. And maybe there's somebody at home, right? And, I don't know if it's male or female, right? Sometimes they switch roles. They've got a nanny who they just pay to take care of their kids, and the nanny's not teaching them discipline for the most part, right? They're not the authoritarian in the home. They're just there to make sure that the kids' basic needs are met and they don't kill themselves.
Yeah.
So yeah, that's a challenge.
Yeah, generally they have the options for good schools and things like that. So as they grow older, they are surrounded by, they understand what work ethic is. You can't really teach like the desire and the want to work hard. It's some, you can teach math, you could teach history, you could teach reading, but like drive, I don't know if you can teach that. You either want it or you don't. And I know people that are broke that don't have drive, right? It's not like, just because you're wealthy, you don't have drive, it's something that you have to see your parents do, and you have to really want it, and listen, even with my family, I have the brother that prefers to work, 25 hours a week and, kind of take life easy. And he thinks I work way too hard. And I think he works way too little. Maybe somewhere in the middle, we're both, right. So it's just who you are. You either enjoy working hard and you get, it's your passion, or you like to stop and smell the roses. And there is a value. There is a lesson to be learned in that, because life is finite. But the bottom line is, to raise family office capital, you need to be creating value for that family office. And that can come in the form of mentoring their heirs or just being a trustworthy advisor in that industry. They have to know and like and trust you. They have to see you bring value to the table. You're not just going to pitch them, bop them over the head. You're not selling a pair of jeans. This is a long-term investment relationship. And by the way, if you think you're just going to go to one of these events and raise $1 million, it's not how it works. You have to keep going to like one or two events. I like Opal and Jaboy Productions. They're pretty good, but there's dozens and dozens of them out there. The Family Office Club, I feel, is so saturated with capital raisers. There's no real family offices there. But, take your spin in any of them, and really at the end of the day, if you keep going to like one or two clubs and really focusing on them and keep seeing the same people there, they're going to start to know, like, and trust you. And over a period of time, you'll start to get those larger checks. I find our RIAs are much harder to raise capital from than family offices. RIAs are the gatekeeper for family offices and high net worth individuals, registered investment advisors. So they're very hard. They're just literally worried about it's CYA, they're just worried about their own brand. They don't want to do anything wrong. They don't want to lose a dollar. They're extremely conservative. They're worried about their fees. So it's kind of a different realm than talking to someone who's actually an entrepreneur, who's actually successful and a high net worth individual, and someone who you can, raise money with. So that's really what I'd say you want to focus on.
Yeah, I've had a handful of other fund managers on the podcast, and there's a couple unique strategies that I've learned about. One was a guy who he helps fund managers start podcasts. And in that podcast is directed towards a specific niche, like doctors. And then what they would do is they would bring these doctors on and talk about their business and give them an opportunity to like actually have a megaphone and just talk about things, because doctors just in general aren't getting invited on podcasts. So like they're getting a little puff and they're like start talking. And then, at some point in the podcast or the conversation, they float the idea of, passive investment into like a syndication. And then, so they're getting a lot of people from these podcast doctors in this particular one. And then they help them do that. And then another guy, he goes to athlete agents. So he finds the agents that represent athletes and then helps them, because these athletes have all this money and they want to put it someplace, but they just don't know. So oftentimes they trust their agents or their other, financial advisors, that usually the agent is kind of involved in that team. And that's something that's worked for him as well. Have you delved into any of those sort of strategies, or do you have any other unique strategies you've heard about?
Yeah, I mean, I've talked to people that manage athletes. I haven't had any success there. I've talked to some professional athletes as well. Again, you tend to get to the gatekeeper of the financial advisor, someone like that, who's very nervous to go into alternatives. Broker dealers tend to be a great source of investors, and so a broker dealer is different than an RIA. RIA, a registered investment advisor, pools individuals' capital together and then generally invests that in an asset class, usually the stock market or bonds and stocks, sometimes alternatives. They have a fiduciary responsibility to their investor. A broker dealer is simply kind of a middleman. They're going to introduce you to an investor. Ideally, you want to find a broker dealer who's more like a sharpshooter, who's going to introduce you to ultra high net worth individuals and family offices, and they should have those relationships for years. And now that's a nice warm introduction, and it's your job to essentially close that capital raise, that investment. There's other types of broker dealers that will charge you a much larger fee. And those types of broker dealers are going to be more retail broker dealers. They're going to go out and they're going to market your deal to 5,000, retail investors, and they're going to get checks between 20,000 to 200,000, and they're going to try to raise you your money there. They're going to charge you upfront fees. They're going to charge you a pretty hefty commission, like 8 to 12%. Now that does get charged out of the deal, paid out of the deal, but it can really add up. The broker dealers I like are the broker dealers that are more charging you a very, very small commission, like 1.5 to 2%. They might charge about 25,000 up front, but then they go out and they introduce you to more institutional level investment groups, fund to fund managers, family offices, multifamily offices, RIAs, ultra high net worth individuals. And these people are just making the connection. It's your job to close them. So they charge you a lesser commission, but it does bring a little more work into your side of the deal. But it makes a lot of sense, because when you have those huge broker dealer fees, it just doesn't make sense. Also, retail broker dealers with their kind of like, that like they spray it out to 5,000 people, see what sticks. Like that strategy is kind of an outdated strategy. You want that sharpshooter mindset. Here's a guy who's worth $100 million. He's probably good to write a $1 to $5 million check, and then if you can be introduced to 5 or 6 people like that, then that can lead you to the right. The kind of quality over quantity type of investor.
Yeah, that makes sense. Earlier when I was doing some research on you, I went to your website and on the peoplescapitalgroup.com, and I was looking at your portfolio, and I was surprised to find like a pretty wide range of different assets, like all the way down from like a single family short-term rental all the way to like 40 plus units, mainly in New Jersey, but all different kinds of assets there that you're working on. What are you working on right now that's interesting that you like? Anything you're in love with?
Yeah. So we don't do the single family short-term rentals anymore. That was just kind of a phase during COVID when it was super hot.
Right.
And we focused more on 40 to 160 unit opportunities in northern New Jersey with an hour commute to Manhattan. Generally class A, B, or C real estate that's mismanaged, rents below market value. some serious value add, whether it's in the management of the asset or physical improvements to the building. And we're generally targeting 16 to 20% IRRs to our investors. We are really targeting more of a 3-year sale these days. We buy it for a good price, off-market, discounted deal. We reposition it, force value into the asset, create cash flow and equity growth for our investors. Then we harvest that equity growth over about a 3-year period of the sale. So that's what we're identifying right now. And I just submitted an LOI about 5 minutes before jumping on the podcast here with you on a 65-unit building that's got 25 vacant units. The elevator's broken. The seller is just pulling his hair out managing this thing, kind of mismanaged, needs like $2.5 million of work. So I just submitted a $7.1 million offer.
Is it for sale, or is this like a pocket listing or something off market?
It's a wholesale deal. Yeah, it's like
the
wholesaler is like direct to the owner. I don't buy anything like sitting on the internet. If it's sitting on the internet, it's not a good deal.
Right. I mean, unless you just
off market. Yeah.
You submit that, that low ball offer. I mean, something like this, it's what is it? It's mostly vacant, right? It sounds like you said 60 units or 20.
It's like a third vacant. Yeah. Mm-hmm.
A third.
And it's actually, he said he would take like $7.5 million, maybe $7 million. I think there's 3 other offers, and when you're dealing with a wholesaler, if you know the wholesaler, I'm like, what are the offers? She told me, she's like, they're 6.5, 6.8, and $7 million. I was like, okay, thank you. So now I know I need to offer 7.1 to get the deal. So, where a broker's going to be a little more, I guess, professional or fiduciary responsibility, a wholesaler is just like in it for themselves. They just
they just want the deal under contract and closed.
Yeah,
that's how they get their fee, right?
Yeah. So so you just you need
that sounds like
relationship in place.
Yeah, that's great to have the wholesalers. You didn't mention that earlier on some of the strategies. Like, there are wholesalers out there that are finding these multifamily properties, and it makes sense. I mean, I always picture wholesalers doing single family and maybe some small multi, but they're out there doing land. They're doing multifamily, maybe even like commercial or industrial. There's always somebody out there who knows about a deal that others don't. So it makes sense to tap into that network of people who just, they have the hustle in them and maybe some of the marketing and lead gen, but they just don't have the capital to take these deals down by themselves.
Right.
So yeah, wholesalers is a good one.
Yeah.
So this opportunity you're working on now is the one that, if you can get it under contract, you're going to start fundraising for it. And everybody that's in your group now, like, are there people that are just like waiting for the next deal, or are you going to have to go out and raise fresh cash for this one?
Yeah, we have about $2 million of soft reserves in place right now amongst about, 16, 17 investors. We have some family offices with some liquidity events that just happened that we want to get them lined up as well. And then we have a whole list of investors we're going to call on and do a marketing campaign and a webinar and a pitch deck once we get the deal under contract.
So probably over the last decade, you guys have built a pretty good database of people that were interested in one time or another in what you're working on. And how are you keeping them in the loop? Do you do a newsletter or like emails pretty regularly to let them know what you're working on and keep their interest there?
Yeah, I do a podcast episode every 2 weeks on the Passive Cash Flow Podcast. I do a passive investor master class generally every month, about 10 months of the year. I do different topics there that teach you how to build and preserve your wealth generally in real estate. I'll talk about market cycles, the lazy 1031. Sometimes I'll have guests on the master class that talk about like tax strategies and things like that. I do a weekly email blast out to our 5,000 email recipients that's going to be updating them on different events and content we're putting out, opportunities and so on, market updates. I do an investor walkthrough twice a year of one of our buildings. I just did one this Saturday, and investors come out, they walk through a building we're repositioning, they see our team at work, we tell them exactly how and why we do it. And then we close. We pitch them the deal at the end. And that's a great way to raise capital. We do networking events. We get about 50 to 60 people out to a brewery, once in January, once in June. January is going to be our kickoff meeting. We're going to talk about state of the market, state of the union, right? And what's going on in the market? What do we see for this coming up year? It's going to be realtors, lenders, investors, people in the industry, and people out of the industry as well. Other passive investors looking to get in, and they see us. I'm the keynote speaker every single time. The June event's going to be like kind of a halfway market update. What are we doing? What's the market doing? Very New Jersey focused. The group is called New Jersey Real Estate Network, after all, and our brand is New Jersey Real Estate. Then we do a client appreciation party every November. That kind of winds down the year. We talk about what we did this year, where we're headed for next year, the next 5 years. That's invite only to our investors. That's in a nice restaurant. And then in addition to that, I'll go out and I'll network to other like family office events, and I'll go out to other REIAs and I'll speak there. Generally, my rule for a REIA is I'm not going to go unless I'm speaking. I don't really just show up to REIAs anymore. I mean, a big part about managing your brand and your image is like being the keynote speaker at these events is really where you want to be, at least after how many years I've been doing it. So just showing up and like poking around the floor and like trying to raise 30 grand isn't really my style anymore, So I go to speak generally. If I'm not speaking, I'm not going to go to just some random REIA,
Yeah. Yeah, that makes sense. Do you go to any sort of national conferences or anything like that where fundraisers are getting together? I remember this thing called the Pitbull Conference. Do you remember that? It's from I think it was like 4 or 5 years ago.
Yeah, I mean, I get, if you really want to raise capital, you shouldn't be in a room full of people trying to raise capital. Like, I'm not saying you can't learn from those. If you're getting started in this business, you should go to those, right? Like the Best Ever Conference. It's a great conference. I was asked to do the pitchathon last year, right? So I got up on stage and I pitched my multifamily deal to the judges, and that was a great experience. If I wasn't asked to do that, I wouldn't have gone, right? You don't raise money by going to a room full of a bunch of people looking to raise money. That's not where the money is. The money's in the room with the people who have money. Go to those rooms. Now, if you're brand new to this business and you want to learn all the service providers, the heavy hitters, the guys out there doing it, go to the Best Ever Conference. I mean, it's a really good conference. I love Joe Fairless. I think they're a great group, man. I wish I was doing what Joe's doing. He's a very successful entrepreneur. But that's not really how you raise money.
Yeah.
Go to a family office event. You go to a high net worth individual event. You'd be better off going to something that has nothing to do with real estate. Go to a doctor's continuing ed event and get a sponsor table there for $5,000. Those bunch of doctors in a room for their continuing ed. Go to a dentist continuing ed event. Go to a room that has nothing to do with real estate. So you're the only real estate guy there. Now you're unique. Now you're of value.
That's great advice. Yeah, I've heard that before. And you forget about it because you think you want to be around all the other people that are moving and shaking, but you're right. You want to be in the room with the people that actually have the liquidity, that can make the investment, and you're not like everybody else. So people are asking you a bunch of questions, probing. So that's great advice. Well, we're coming up against the end of the hour here, and I want to thank you for being here. And I got my fingers crossed for you on this LOI that you got out on this property. Hopefully you get under contract, but if anybody here is listening and they want to, get on your mailing list, or they want to attend one of your trainings that you do, or, check out your podcast, how can they find you and then potentially learn about this new opportunity you've got coming up?
Sure. So our podcast is the Passive Cash Flow Podcast. That's on Spotify, iTunes, all the major podcast platforms, on YouTube as well. Our website is capitalgroup.com, peoplescapitalgroup.com. There you can find the Passive Cash Flow Podcast. You can find our master classes. You can find our webinars. You can find our ebooks and our white pages as well. You can review our investment opportunities, our past performance, and upcoming offerings. And so it's a ton of content, peoplescapitalgroup.com. You can also put us into YouTube. We have hundreds of YouTube videos. A lot of our podcasts are up there also. So you can just search People's Capital Group on YouTube. You'll see us there. But if you go to peoplescapitalgroup.com, you can get in touch with us, a member of our team. You can set up a call with them. So that's the best way to connect with them. You can email me at aaron@peoplescapitalgroup.com, but you're probably better off going to peoplescapitalgroup.com and connecting with a member of our team there and scheduling a call. We try to buy about 2 apartment buildings a year, and we have an investor wait list you can get on. Once you're on the wait list, if you're qualified, you'll get sent the upcoming opportunities when they arise.
Awesome. Well, thank you so much for being here, Aaron. I really appreciate you taking the time and sharing your experience and some of the past projects you've worked on, as well as some nuggets of inspiration for others that are maybe on the fence or doing this. But also, I just think there's a lot to be said for somebody who is out there in the trenches, like evaluating deals, raising capital, staying up to date with like all the new trends and what's happening in the market. So I really appreciate you taking the time.
Definitely, Benson. Thanks for having me on. I appreciate it.
You got it. And everybody, thanks for listening to this edition of the REI Hacker Podcast. Keep an eye out for more amazing guests like Aaron in the future, where we talk about real estate, entrepreneurship, business, and everything about wealth generation. So thanks for listening, and we'll see you next time. Take care.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.